New World Development is more than just a company. It's a pillar of Hong Kong's identity, deeply intertwined with the city's narrative. For decades, its presence has been a constant, a symbol of progress and prosperity, shaping the city's skyline and daily life since 1970. From residential complexes to commercial hubs, New World's influence is undeniable. Its projects have not only transformed the physical landscape, but also the way people live, work, and interact within the city. Founded by the visionary Chung Yutung, a man who understood the potential of Hong Kong and the aspirations of its people. It's one of the Big Four developers, a powerhouse that has consistently shaped the real estate landscape. These four companies have historically held significant sway over Hong Kong's property market, with a portfolio spanning residential office, creating spaces for people to call home, and businesses to thrive, hotels, and retail. Their diverse holdings reflect a commitment to meeting the evolving needs of a dynamic city. Its projects like Victoria Dockside, a testament to modern luxury and innovative design, and K11 Musea, a groundbreaking concept that redefined the retail experience. Blend art, culture, and commerce, creating immersive environments that engage and inspire. These spaces are designed to be more than just places to shop, they are destinations in themselves, aiming to create more than just buildings, but vibrant ecosystems that foster creativity and community. Under Adrian Chung, the third-generation CEO, a young and dynamic leader with a global perspective. The company has pushed a modern, experience-driven vision, embracing innovation and technology to enhance customer engagement. This approach has won praise, earning recognition for its commitment to excellence and innovation, but required heavy investment, a bold strategy that has pushed the boundaries of traditional real estate development. For decades, owning New World property, whether a luxurious apartment or a prime office space, symbolized success and stability in Hong Kong, a tangible representation of achievement and financial security. The company's deep integration into the city's fabric, woven into the very infrastructure and social life of Hong Kong, means its financial health is a public concern, closely watched by investors, analysts, and the general population alike. But now, cracks are appearing, signs of strain and vulnerability in a seemingly impenetrable empire. In what many thought was an unbreakable foundation, a bedrock of Hong Kong's economic prosperity, the city's property market, once seen as invincible, a safe haven for investors and a symbol of enduring value, is facing new pressures, grappling with economic headwinds and shifting market dynamics. New World's challenges, a confluence of factors that have tested its resilience, signal a shift in Hong Kong's economic landscape, a period of uncertainty and transformation. The company's fate could have ripple effects, impacting not only its shareholders but also the broader economy, far beyond its own balance sheet, potentially influencing investor sentiment and market confidence. As a bellwether for the city, a leading indicator of economic health and stability, New World struggles are raising alarm across Hong Kong, prompting concerns about the future of the property market and the overall economy. The question now, a critical juncture in the company's history, can this titan weather the storm? Can New World Development navigate these challenges and emerge stronger? Or will it succumb to the pressures of a changing world? New World's core problem, the issue that sits at the heart of its current predicament, is its massive debt. This isn't just a large number, it's a fundamental challenge to the company's stability and future prospects. As of late 2024, the company's net debt stood at around 120 billion Hong Kong dollars. This figure represents the amount of debt remaining after subtracting liquid assets. When considering total borrowings, the figure balloons to near 198 billion Hong Kong dollars. This includes all forms of debt the company has taken on, painting a clearer picture of its overall financial obligations. Its net gearing ratio, over 80%, a key metric that compares a company's debt to its equity, is alarmingly high for a property developer. This elevated ratio signals a significant level of financial risk and vulnerability. Servicing this debt requires putting immense pressure on cash flow, regular interest payments, and looming principal repayments. These obligations demand a consistent and substantial outflow of funds. Years of ambitious expansion, including iconic projects like Victoria Dockside and numerous ventures in mainland China, fueled this debt. These large-scale developments required significant capital injections, contributing to the company's growing debt burden. The strategy relied on a booming market characterized by ever-increasing property prices and sustained low interest rates, conditions that have now reversed. The market's downturn and rising interest rates have exposed the vulnerabilities of this strategy. The company's assets top 600 billion Hong Kong dollars, representing a substantial portfolio of properties and investments, but much is tied up in illiquid properties. These assets, while valuable, cannot be easily converted into cash to meet immediate obligations. Selling assets quickly in a weak market could mean steep losses. A fire sale scenario would significantly erode the company's overall value. The mismatch between long-term assets, which take time to generate returns, and short-term debt, which requires immediate repayment, is a critical liquidity challenge. This imbalance poses a significant threat to the company's ability to meet its financial obligations. With revenues under pressure due to market conditions and decreased demand, the company faces immense financial strain. This pressure is felt across the organization, impacting its ability to operate effectively. The numbers aren't just abstract, they aren't just figures on a spreadsheet, they represent real, urgent obligations. These are payments that must be made, deadlines that must be met. New World's debt load is now a shadow over its future, casting doubt on its long-term viability and strategic direction. The crisis is about survival, not just profit. It's a fight to maintain solvency and navigate through an incredibly challenging period. Debt is a common tool for developers, often used to finance ambitious projects and fuel growth. It's a way to leverage capital and expand operations. But New World's situation is raising eyebrows and causing concern. The level of debt they've accumulated is alarming, especially considering the significant shift in the economic environment. The global financial landscape has changed dramatically. The era of cheap borrowing, characterized by historically low interest rates, is definitively over. For years, developers could access capital at incredibly favorable terms, fueling a boom in construction and expansion. Now, interest rates have soared dramatically, making refinancing existing debt and securing new loans far more expensive and challenging. This sudden increase puts immense pressure on companies with substantial debt burdens. Hong Kong's monetary policy is closely linked to the United States, so local borrowing costs have surged in tandem with U.S. rate hikes. This synchronized increase amplifies the financial strain on Hong Kong-based companies. Every loan New World refinances now comes with a significantly higher price tag, reflecting the increased cost of borrowing in the current market. This impacts their bottom line substantially. This increased cost of borrowing is directly squeezing profits and severely impacting cash flow, making it harder for New World to meet its financial obligations and invest in future growth. The company faces a double whammy, as it is heavily exposed to both the Hong Kong and mainland China property markets, two of the most significant real estate markets in the world. And unfortunately, both of these key markets are currently facing severe downturns, creating a challenging environment for developers. Falling property prices, driven by a combination of factors, and persistently weak demand are significantly hitting revenues hard, reducing the company's ability to generate income and service its debt. Furthermore, mainland defaults by giants like Evergrande have sent shockwaves through the market, shattering investor confidence. This has made both securing sales and obtaining financing considerably tougher for all developers, including New World. Adding to the pressure, New World's debt levels are notably higher than those of its main competitors in the region, making the company significantly more vulnerable to these adverse market conditions. The aggressive, debt-fueled expansion strategy that New World pursued was undoubtedly a high-stakes bet on continued growth and favorable market conditions. But that bet is now backfiring spectacularly, as the market realities have shifted dramatically. In a capital-intensive industry like real estate development, where large sums of money are required upfront, New World's high leverage ratio stands out as a major risk factor, amplifying the potential for financial distress. The confluence of these factors means that the company's financial model is currently under unprecedented stress, pushing it to its limits. This isn't just another routine debt cycle that the company can easily navigate. It's a fundamental reckoning that demands a complete reassessment of its financial strategy and future prospects. The stakes have never been higher for New World, as the decisions made in the coming months will determine its long-term survival. Banks and investors are growing anxious about New World development. Lenders have billions at stake. A default could mean major losses and tighter credit for the whole sector. Banks are now more cautious, making it harder for developers to get loans or refinance. Investors have responded by selling off New World shares, driving prices down sharply. Bond markets are flashing red, yields on New World's bonds have soared, signaling default fears. Credit rating agencies have downgraded the company, raising borrowing costs and triggering stricter loan terms. The risk isn't isolated. Trouble at New World could shake confidence in all Hong Kong developers. Contagion risk is real. One giant's fall could destabilize the entire market. The financial community is on edge, watching for the next move. The stakes go beyond one company. The whole sector could feel the impact. New World's crisis is a warning sign for Hong Kong's property market. Everyone is bracing for what comes next. New World's troubles could trigger a chain reaction across Hong Kong's property market. A fire sale of assets would flood the market, pushing prices down and forcing other developers to follow. Confidence among homebuyers could collapse, freezing transactions and stalling the market. Construction firms, agents, and suppliers would suffer as projects are delayed or canceled. Job losses and financial distress would ripple through the economy. The government, reliant on land sales and stamp duties, would see revenues fall. Public spending on services could be squeezed. The property sector's downturn would hit the city's finances and employment hard. New World's crisis is a systemic risk, not just a corporate one. The entire city could feel the shockwaves. New World's crisis echoes past real estate collapses worldwide. In China, Evergrande and Country Garden grew fast on debt, then crashed when the market turned. Their downfall shows how quickly confidence can evaporate when leverage is too high. Japan's 1990s property bubble burst left companies drowning in debt, triggering a lost decade. The 2008 global financial crisis proved that real estate and finance are deeply intertwined. One can drag down the other. The lesson: high debt and falling asset prices are a dangerous mix. Even the biggest players can fall if the cycle turns. Hong Kong's developers have long relied on leverage and rising prices. Now, the risks are clear. No market is immune to financial gravity. History warns that unchecked debt can have devastating, lasting consequences. New World's predicament is a stark reminder of these hard lessons. The past is repeating itself in Hong Kong. If New World can't manage its debt, the fallout will be severe. Debt restructuring would mean losses for creditors and shareholders, signaling deep trouble. A default could trigger cross-defaults, forcing immediate repayment of all debts and likely bankruptcy. Assets would be sold off at fire sale prices, wiping out shareholder value. The shock would hit banks, tightening credit and hurting the wider economy. International investors might pull out, damaging Hong Kong's reputation as a financial hub. Construction projects would halt, jobs would be lost, and homebuyers could face big losses. Property values would fall, eroding household wealth citywide. This wouldn't just be a corporate failure, it would be a social and economic crisis. The city's stability is at stake if New World falls. The consequences would be felt by everyone. New World's survival depends on bold action. The company is selling non-core assets to raise cash and pay down debt. Finding buyers in a weak market is tough, but necessary. Bringing in new investors or partners could inject much-needed capital, though it may mean giving up control. Issuing convertible bonds or other creative financing could help shore up finances. Cost-cutting and halting new projects are essential. Growth must give way to stability. Completing and selling existing projects is now the priority. Open communication with lenders is crucial to maintain support. For Hong Kong, this is a wake-up call. The government may need to support the market and rethink its reliance on property. The era of debt-fueled expansion is over. Sustainability is the new goal. The path forward is about survival, discipline, and rebuilding trust. New World's crisis is a turning point for Hong Kong. The risk of contagion is real. One company's fall could trigger a broader financial shock. The era of high leverage and ever-rising property prices is over. The lesson: strong balance sheets and conservative management matter more than ever. Transparency and clear risk assessment are essential for investors and regulators. The market must now judge companies by their financial health, not just their brand.